Bitcoin's only 15 years old, a little bit over that. And I mean, and it's already a tenth the size of the entire market cap of gold. That's just mind boggling. So why is that? Well, people are looking for pockets to hide in during these prolonged bouts of high inflation, where the inflation's been over 2% for pretty much ever, since the great financial crisis. And so when you have people who are just looking for somewhere to hide, of course they're going to hide in gold, but they're not hiding in treasuries. That's the really interesting thing here. So when you look back 4 years, I mean, we are in an adoption phase in Bitcoin. It's only 15 years old.
Inflation's been running above 2% since the 2008 financial crisis, and history shows what investors do when that happens. They look for safe havens. Gold used to be the obvious choice. But this time, something's changed. James Lavish, CIO and macro strategist, says investors aren't running to bonds or treasuries anymore. They're moving toward Bitcoin. Still, he's clear, Bitcoin isn't fully there yet. Most investors, maybe 80% or more, still see it as a risk-on asset, something you trade, not something you hold. Institutional players, in particular, continue to lump Bitcoin together with the thousands of speculative coins that rise and fall every year. They don't see that Bitcoin stands apart, decentralized, limited in supply, and built to outlast every market cycle. But that perception is starting to shift. Lavish points out that Bitcoin often holds steady when the rest of crypto collapses. Its price even tends to follow gold's movements, just with a lag. That pattern is catching the attention of analysts and major banks. The irony, he says, is that JP Morgan, whose CEO once called Bitcoin worthless, recently published research admitting Bitcoin now plays a role in what they call the debasement trade. In other words, when fiat currencies weaken, Bitcoin strengthens. That's the same logic that once made gold the world's ultimate hedge, and it's why more investors are beginning to see Bitcoin as digital gold in the making. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that actually understand what's unfolding. Thanks for watching.
One of the things you have to take in consideration here is that Bitcoin's only 15 years old, a little bit over that. And I mean, and it's already a tenth the size of the entire market cap of gold. That's just mind boggling. So why is that? Well, people are looking for pockets to hide in during these prolonged bouts of high inflation, where the inflation's been over 2% for pretty much ever, since the great financial crisis. And so when you have people who are just looking for somewhere to hide, of course they're going to hide in gold, but they're not hiding in treasuries. That's the really interesting thing here. So when you look back 4 years, I mean, we are in an adoption phase in Bitcoin. It's only 15 years old. So it's going to continue to have plenty of people, Mike, who think about it exactly the same way as you are describing it, which is a risk-on asset. It's still, it is still I would say the majority of investors think of it that way. I'm very confident that the majority of investors think of it that way. Probably the vast majority, probably 80% of investors think of it that way still. Yeah. Maybe even more, especially the institutional investors. They just don't understand it yet. Why? Because you see these articles, they just lump it in with everything else, just like you say, where there's thousands of other cryptos that they can be buying. It doesn't have to be Bitcoin, right? And that narrative continues. So the difference is when people start understanding, wait, why is Bitcoin staying here when all the other cryptos start to collapse? Or why is Bitcoin moving with gold behind it on a lag? Why does it follow gold like this so closely? And that when you get that understanding, that's when you're starting to get, and you start getting articles like this out of JP Morgan. Just remember, JP Morgan's CEO describes Bitcoin as a scam, as a Ponzi, as worthless, as you know, I don't think he's used rat poison. He may have quoted Charlie Munger on it, but his bank put out a piece saying that it's part of the debasement trade. That is like, this is so important for people to understand that the rest of the street follows JP Morgan in a lot of ways. Not all the analysts, not all the bank, but they have to take their comments into consideration. It's a powerful bank. And, you know, now you're starting to have that conversation. And so that's what's not different this time. That's how Bitcoin is evolving. Like, it's taking time. I said this for a long time. It's going to take time. And that's why you're seeing this kind of price activity. As far as, you know, Bitcoin versus the stock market, it's exactly what you said. It's the attitude towards Bitcoin has not changed much yet. And I disagree with you that everybody knows about it. Everybody's heard about it, but they have no idea what it really is. They have no clue. I still talk to people that I've told Bitcoin about 4 years ago. And I used to think it's my problem that, you know, that I am not explaining it properly. But then they come back at me with article after article about how Bitcoin is used for, you know, illicit activity. It's a Ponzi scheme. There's no value to it. And I can point to these articles on CNBC and Bloomberg and wherever else that prove me right. And, you know, they just still have not, they just can't get their head around it being a different technology.
James Lavish says that when an asset like Bitcoin or a stock breaks into new territory and reaches an all-time high, the market enters what traders call price discovery. There's no historical roadmap above that level, no past data to show where sellers might step in or where resistance might form. The market is essentially exploring, trying to find the next price that balances buyers and sellers. Professional investors, Lavish explains, manage this uncertainty by setting mental checkpoints. They watch the charts and identify likely zones where profit-taking might occur, often at clean, round numbers like 130, 150, or 180. Those levels matter because human psychology gravitates toward round figures when deciding where to sell or protect gains. At the same time, traders don't ignore what's below them. They look at previous support levels. Say the last strong buying zone was around 108. From there, they might map potential moves. A 25% gain brings prices near 135, while a 50% move targets around 160. These percentage markers act as reference points for scaling out of positions. Lavish says that's how professionals navigate uncharted highs, by combining psychology, math, and pattern recognition to find structure in a market that's otherwise flying blind. Let's get back to the interview.
Everyday investors look at charts and they're trying to figure out where's this thing going. And now you're bumping against all-time highs, right? Once you get through the all-time highs, we talk about price discovery. Well, we talk about price discovery because there's no structural liquidity that's sitting there waiting to meet the other side of demand. So because you're at an all-time high, it's searching for the next price that you have sellers to step in. And often, professionals will look at the charts and they'll say, well, 125. Well, the next levels are going to be mental levels where people just mentally set their targets, their stop outs, and where they're going to sell some, where they're going to take some profits off the table. 130, 150, 180. So they're round numbers that people look at. The other thing that people look at is, or professional investors, they'll look at and they'll say, okay, where was the last real strong support level? Okay, say it's 108, right? Say it's a pretty strong support level if you look on the weekly. And they'll say, well, what's 25% up from there? And so it's about 135. And that's another mental level. So instead of 130, 135, because you think, well, if it gets up, I bought a lot at 108. So if there were a lot of buyers at 108, and they'll say, well, up 25%, I'm going to sell some. Up 50%, I'm going to sell some. So those become levels as well. And that's where you find these levels. So it's not just like random liquidity comes in. This is more of the personality of the stock and psychology of investors and where they've bought and where they're ready to get out. So it's difficult to tell. But that's why you have these jumps in price where there's pockets of illiquidity because there's nobody standing there ready to sell at, say 127 or 132. It's like you've got these levels that people set. People are expecting, the investors are expecting the Fed to cut again because there's no new information. The ADP it's kind of a problematic number for the Fed. They don't really have control of they don't see through that as much as they do the typical US data. So I think it's just status quo, and status quo is concerned about jobs, which means that they're going to cut 25 basis points. They may have held off until December if they had different information, but we're not getting any data until the government. Something you said, Mike, I do have a brother-in-law who's military also, and they're paid, but they're going to get their get caught back up once the government reopens, at least on that side. Although Trump is taking advantage of it appears, of the opportunity to just get rid of a bunch of fat, and so he will cut some of that. That honestly, I don't know how really additive that is to GDP anyways. So not really concerned about that. The debasement trade is interesting, and what's really interesting about it is I just shared this screen, Scott, is that JP Morgan's piece about the debasement trade, and we've been talking about it for years. So this is nothing new. This is nothing that is groundbreaking. What's groundbreaking about it is that the probably the strongest bank in the world is now being forced to recognize it, and they're actually having to they're having to advise their clients on this and include Bitcoin in the conversation. So that is what's so important about the debasement trade that you're hearing about, that JP Morgan identified recently. And so what's incredible about that is now you have Bloomberg actually reporting on it. Unfortunately, you still have Richard Henderson. Maybe you can have a Mike, maybe you have a talk with him, but he's still just grouping Bitcoin in with crypto. So the crypto rally, but throughout the article, and obviously the only crypto that is charted is Bitcoin, because that's the only one that can't be debased. And that's the key for people who end up reading these articles. And so, but what's really interesting about this is that Bitcoin has a long way to go to catch up to this gold silver rally. And Mike, you've been right about this, that, gold has taken off, and I'm not surprised. I'm not surprised that gold took off first. I wrote about this a few weeks ago, that gold is the leading indicator for risk around the world. When you have a risk off trade, people are going to either gold or treasuries, but they're going to gold because, Scott, you just pointed out the treasuries are going up. The treasury yields are going up as we get a drop in rates. Why is that? As the Fed cuts rates, you have yields going up on the long end of the curve. Why? Because people are worried about inflation, which means that makes sense, that yields are going up, gold is going up, stocks are going up, Bitcoin's going up. And ultimately, it's hard to tell what's going to happen with the housing market, but that might just go up too, because when you're cutting rates, it loosens up the supply, and suddenly you've got the demand there, and there's capital looking for pockets to hide in, while the government continues to just relentlessly debase the currency that all of the treasuries are based in. So that's a really big deal. I'm going to tee you up, Dave, for the rest of the conversation quickly there.
Something fascinating is happening in the world of money. The same investors who once turned to gold during inflationary storms are now watching a digital alternative rise from the shadows. It's not just speculation anymore. It's a quiet reassessment of what store of value really means in an age when central banks print endlessly and debt piles never shrink. Bitcoin is starting to earn a place in conversations once reserved for gold and government bonds, not because of hype, but because the logic of the system itself is changing. For decades, markets relied on familiar signals: interest rates, treasury yields, and inflation targets. But now those signals are breaking down. The old safe havens don't feel safe when currencies keep eroding in purchasing power. Bitcoin, with its limited supply and decentralized nature, has become a mirror reflecting that growing distrust. Every time institutions dismiss it as too volatile, another quietly begins adding it to balance sheets. It's a shift that feels less like rebellion and more like inevitability. As global investors recalibrate what they trust and why, one question looms. Are we witnessing the early stages of a new monetary standard, or just another phase in the search for stability? So stay tuned. If you're into real, data-backed takes on the financial system, hit like and subscribe so you don't miss the weekly updates. Thank you for the support, and I hope you enjoy the video.